Good afternoon, ladies and gentlemen. Welcome to this webinar on digital transformation for corporate treasury. My name is Helmut Schnabel. I'm chairman of IGTA, and I'm going to introduce you to this webinar and later close this webinar. Let me say that for IGTA, the International Group of Treasury Associations, this is the first webinar of our own which we offer together with ACT, the British IGTA member association, to the worldwide community of our IGTA member associations. Now, first of all, I would like to briefly run through a few technical points about the webinar setup. There is a menu bar across the bottom that allows you to open various windows, and you can move these around your screen, resize them, or minimize them. The yellow button with a question mark is for help if you have any technical difficulties. The purple Q&A widget opens a new window. You can send questions to us by typing into the window. Don't wait until the end to send your questions. Please send them in as they occur to you, and we will be dealing with them at the end of the presentations. We won't disclose any names. The resource box is a location where you can download further information about this webinar and other events in the ACT calendar. I should add that a recording of this webinar will be available on the ACT website in a few days' time, along with a separate copy of all the slides. Now, I would like to introduce to you the speakers we'll hear from at this seminar. There is Richard Magrann, Magrann-Wells, our first speaker, head of North American sales of Adjoint Corporation. He will be followed by Brad Fox, former chairman of National Association of Corporate Treasurers, USA. And the following discussion will be led by Tom Dees, chairman of National Association of Corporate Treasurers, USA, and board member of IGTA. Now, let me hand over to Richard, please.
I believe we may have a technical issue right now. Richard, please, could you unmute the phone and we will continue with the webinar. Thank you.
Well, very sorry. There's been some problem with the technical. Helmut, thank you very much for the introduction. We have a very big topic to cover today, digital transformation for corporate treasury. A very big topic and not a lot of time, so we're going to jump right in. Our agenda is going to include a quick introduction to some of the ideas and some of the technology. We're going to talk about specifically some key principles when it comes to blockchain and how that applies to treasury and products that are existing now and products that we believe are coming down the pike. Here's a picture of your two speakers. That would be me and Brad Fox who will be presenting in a bit. But by way of introduction, let me introduce you to our company. Adjoint developed its own distributed ledger technology, our own protocol called Uplink. We use that product to help build out financial service products. It was specifically designed with scalability and security in mind. So that's what distinguishes what we're doing from some of the other lesser technologies that are out there. But again, let's jump into the idea of transformation in this space. I think what's critical to understand is that transformation is very difficult to see when you're in the middle of it, but we are in the middle of it. For those of us with a little more gray hair, we remember when Lotus 1, 2, 3 was just getting started back in the 90s, and spreadsheets changed the way we calculate, the way we do finance. That transformation seems so subtle at the time, but it's made a huge difference in the impact. Email did the same thing back in the 90s. The way we communicate, whether it's by text or by email, it changed the way we communicate. Blockchain and distributed ledger technology is going to change the way we share data over the next 5 years. You're going to see a huge impact. When you can trust the data that you're sharing with other people, it makes a huge difference. Today, specifically, we're going to be talking about two separate ideas. One is a product that we already have up and running and in use in Europe with corporations using digital ledger technology to reduce costs in their treasury platforms. We'll also talk about the potential use of DLT for funding products, and Brad will be covering that. So, not everyone is completely familiar with the jargon and the language. Some of you are probably experts and some of you maybe less so, but just by way of background, the important things to note are that distributed ledger technology creates a permanent and immutable audit log of everything that takes place, and that all those communications are distributed over a network. Instead of the old processes of one centralized database, we're now talking about that data being distributed and reducing risk. Now, what's important is when we're talking about treasury products, it is critical that we're not talking about the kind of blockchain that involves public permissionless. Like we see with Bitcoin, that is a public permissionless type of blockchain. We are not talking about that. We are talking about private permissioned blockchain. This creates, this kind of multi-entity consistency is important. When you share data across multi-entities, it's important that that data be consistent. That's what this is about. That's what permissioned private blockchain is all about. Now, DLT by itself is important. It's a very important technology breakthrough. But what has really made this a digital transformation at this time is when it's combined with other technologies as well. So we start with distributed ledger technology using that kind of immutable audit log. But when it's combined with smart contracts, and for those of you who aren't familiar with the term, it's not a legal term. I am a lawyer by training, but this is not a legal contract. Smart contracts are self-executing workflows. So self-executing programs that can be built into ledgers. When you take that second piece, that second building block, and combine it with the third building block, application programming interfaces, APIs, that allow data to be moved back and forth across platforms automatically, those three combined, those three building blocks combined, create a very powerful platform for transformation. That's what we're proposing, and that's what we're doing for some of our clients. So, how is DLT transforming Treasury? We've seen, obviously, traditional banking allowed for cash pooling. That was great. You could use lockboxes and all of that going back to the 80s and 90s. We saw in-house banking start to come about almost 20 years ago. maybe more, we started to see single banks offering in-house banks that allowed companies to share funds and move funds internally within their own company, as long as you were using their bank. Then we started to see more sophisticated in the last few years, we've started to see banks create virtual account management. So getting closer to what we're talking about, but they were able to, if you're using a single bank, you were now able to share and do transactions within your virtual account. What's different with what we're proposing and with a digital ledger is that now you can actually move data, including metadata, with the transaction. You have improved reconcilement, immediate reconcilement, and workflow management. So this progression, this gradual transformation, we've gone from traditional banking all the way through even in-house with virtual account management. We believe this is the next step. But let's talk about specifics of what it would look like. In fact, it's hard to believe that still almost a third of Treasury surveyed still show that they manage much of their accounts on Excel spreadsheets. We believe this is the fourth generation, not the third or the second, but the fourth generation. So we look at Treasuries frequently today. You've got subsidiaries. In our example here, we've got a US, a French, and a Singapore subsidiary. And they may have a dollar and a euro account. And if they want to do intercompany payments or intercompany loans, it requires normal spot transactions and movements of funds and all of those issues. There's cost, there's delay, there's risk, there's reconcilement and the time that goes with it. We've created a new structure that, when combined with what we're proposing on the technology side, creates a really powerful platform. We've created a pooled account. This is a secured interest. So all three subsidiaries have a secured interest in a common pooled account. They have a pooled dollar account and a pooled euro account. So now we have three subsidiaries. They all have a secured interest. The value of that secured interest is dependent upon their share of the pooled account. This is going to create all kinds of efficiency, speed and control, strategic benefits. We'll get into that in a second. Stepping back one second, the way this is going to work, you've got that central account, you've got that pooled account, but now all the information that is needed, we're not talking about destroying any existing relationships, we're not talking about tearing down your legacy treasury management system. We're talking about an overlay that allows them all to talk to each other. And that's the beauty of what we're talking about here. So we've got payments and foreign exchange and loans going from your existing systems, your integrated systems. So your SAP, your FIS, your Oracle, or others, those systems are feeding data. Payment, foreign exchange, loans, all of that data is being fed into a distributed ledger. That distributed ledger can generate instructions through APIs. Those instructions, and again, this can all be automated. Those instructions are being fed into your banks, whether it's HSBC, Citi, Deutsche, and those banks in turn are generating statements. Statements coming back, all of this recorded in the ledger. That statement comes back through the ledger, and then back into, the bank statements are fed back into your Oracle and FIS systems. Okay? So what we've created is this interesting opportunity for all of these systems to communicate through a common platform. Okay? It gives you a single real-time view across your entities. And that's what we're trying to create, is real-time view of what your positions are, not batch reconcilement. So what is the core design? Let's look at the actual accounts. So here what we've created is a view of the master account at the top there. And there you can see that you've got euros of 120 euro and dollars of $305 in the master account. The and that's the master account that's owned by all three subsidiaries. The three subsidiaries have different stakes, different secured interest in that pooled account. The US has $100, France has $200, Singapore has $5 in the virtual account. Down below you see the various sources that are impacted. So you might be pulling data from a foreign exchange or interest rate source of data. In this case we have Thomson Reuters, but it could be others, Bloomberg or others. You may have your ERP, which can be FIS or Oracle or others. And then you've got your treasury management systems. This whole time you've got this kind of ownership exists at that time, but can change for every transaction. So let's do a simple transaction, an inbound payment. So if someone from the outside, a third party, makes a payment into the pooled account, the value of the pooled account goes up. Very simple. That's recorded on all your systems. And as you can see down below on your ERP and your treasury management system, that payment gets automatically recorded. Very simple. Now the master account has gone up in value, and the value of the U.S. subsidiary has increased. Their share, their secured interest in the master account has increased. Now, we'll move along to something more interesting. Let's do an intercompany transfer. Now, with this kind of virtual account, doing an intercompany transfer is simple and clean. Now we have a transfer here of 20 virtual dollars from the US to the French subsidiary. So now the account has stayed exactly the same. The master account hasn't changed in value at all. The money is moved on the virtual ledger from the US to the French subsidiary. You see that it recorded in both the ERP and the treasury management system. But this is done in real time. It's done without delay, instantaneous. But what's really interesting here and powerful is the metadata. You can attach actual documentation. You can attach all kinds of documentation that makes the reconcilement simple. That's, in fact, one of the motivations for our clients that have the system already up and running. It's been one of the primary motivations that's encouraged them along the way. So now they're able to move money and reconcile those loans automatically. Let's do a spot transaction, foreign exchange. I spent many years in foreign exchange, and I can tell you the spot delays and costs that are associated were a true headache for many large corporations. This removes a lot of that, especially for the intercompany flows. So here we're talking about a US doing a swap of 33 virtual dollars with 30 virtual euro with this French subsidiary based on market source data. So they're pulling an exchange rate from a third-party objective source. You'll want that obviously for records later for tax purposes, but you can pull that automatically. That rate is pooled, the transaction takes place, the ledgers are adjusted. The master account, however, doesn't change at all. The secured interest of the two parties in the master account does change. All of that is recorded both on your ERP and TMS automatically. Okay? And again, any required metadata that needs to be transferred is transferred. Let's look at intercompany loan. So now we have France making an intercompany loan to Singapore for 6 months. Now, we can pull an interest rate from a third-party source, and we can talk about what's going on in the LIBOR market and all of that. But pulling that source of data, they can pull a LIBOR and then add some spread on top of that. But if they want an objective source, they can pull that from a third party. Then, in this case, we've used 2% as the interest rate for 6 months. The payment goes back after 6 months. All of that takes place without any change in the master account. So the master account remains stable. The subsidiary accounts have changed. All of that gets recorded to their ERP NTMS in real time. So we buzzed right along. We've talked about all of the potential here, what we can do, but what's the real value in it? How are you saving money? What we've shown is that the amount that can be saved depends on two factors. One is the number of accounts that are involved and the amount of liquidity. Our calculations and the calculations of clients that have already had the system up and running have shown that if, on average, if you have $1 billion in average liquidity that's there, and depending on the number of accounts that are involved, the savings can be substantial. The savings are in part based on efficiency, liquidity, transactions, and FX. You can see that what you're talking about is reduction in bank fees, obviously settlement, the time it takes for settlement and spot trades and all of that, substantial. But in addition to the transaction and FX, what we see is really the visibility and the view and the metadata that I mentioned makes a huge difference in what we're talking about, the time saving. Our client that's currently up and running and using this system is saving almost $10 million annually because of the flows that they're looking at. That's been talking about just our treasury management. We're going to talk about the potential for funding use using digital distributed ledger. Brad, I'm going to turn it over to you and let you talk about that, and then we can wrap up at the end.
Okay. Thank you, Richard. I wanted to say a quick hello to my friends at IGTA and to my colleagues at NACT that are on the line, particularly those on the West Coast who are looking at the 0600 time zone start on a Monday morning. So appreciate those people in particular joining in. I wanted to talk about the traditional commercial paper issuance process as a case study on how distributed ledger technology could work. While the current process has become more efficient over the years by going to book entry recording rather than certificate issuance, if you remember the images of runners and bikers racing around New York delivering commercial paper certificates, well, we've at least done away with that over the years, but the process is still very manual, involves a lot of intermediaries, and that adds costs. So let me describe how the current process works using my previous experience when I was the treasurer of Safeway, the North American grocery chain. In 2008, Safeway was one of the largest Tier 2 rated CP issuers in the country with a $2 billion program, 4 dealers, and significant outstandings. Every morning, our dealers would send us a rate run on where we saw our yields at various maturities from overnight to 90 days. We would place our orders. The dealers would contact their investor bases and book the trades, collect the money from the investors, put it in our bank account, and send a report to our issuing and paying agent, who would then enter the trades into the book entry ownership records at Depository Trust Company, DTC. If we needed money later in the morning, our dealers would inventory our paper on their books overnight and then place it in the market the next day. Everything was going great until it wasn't. The Lehman Brothers bankruptcy in September 2008 sent shockwaves through all markets, but money markets and commercial paper were particularly hard hit. The short-term markets froze, and what CP investors remained were demanding much higher yields. Our yields went from 2% levels to over 6%, and our spreads from 20 to 30 basis points over equivalent LIBOR to over 400 basis points. Every day was a jump ball to see if we could get funded, and none of our dealers were now able to inventory our paper if necessary. We started to find our own investors and direct them to our dealers to help fill our orders. Many issuers drew on their bank lines in order to get the funding they needed. Our dealers would cut their commissions on the trades we would steer their way, but it still didn't seem right to us to pay them for our investors. I had heard of a portal on Bloomberg that allowed for direct issuance of CP, so we researched how it would work. We registered for the portal, developed our own offering memorandum and a questionnaire for interested investors to complete, and then decided who we wanted in the program. instead of our dealers collecting money, the investors would pay us directly. So there was some credit qualification we needed to do and make sure that we were taking settlement risk, that we were going to get funded on that day. We informed our dealers that we would be issuing directly as a way to increase our investor base and would not be competing with them on rates. We also posted yields for longer maturities only, 30, 60, and 90 days, and let our dealers continue to work the shorter trades under 30 days. Our yields would be the same to the investor that our dealers were quoting for longer maturities, but in this case, we were saving the dealer commission on any trades completed. We were the only Tier 2 industrial company on the Bloomberg portal. They were mostly Tier 1 financials, banks and finance companies, and we got some immediate attention from smaller money managers and some of our technology corporate neighbors in Silicon Valley and California. This is a whole new investor base for us, and pretty soon we had 20 to 30 investors and had placed several $100 million in longer maturities, taking some of the funding heat off of our program. It was a great success for us, and we had expanded our investor base and gotten to know our investors directly. We had lengthened our maturities, and we were saving a lot of money on dealer commissions. But it was still a pretty manual process. We sent out offering memos, memorandums, and questionnaires by email. We prepared a daily report of trades for our issuing and paying agent to record at DTC based on the trade tickets we printed off of Bloomberg. Now let's go to the next slide and envision how distributed ledger technology could work and make further enhancements to the CP issuance process. There we are. So what you see here immediately is we've got arrows going in two directions. The green arrows trace the movements of cash. The black arrows show the information that's recorded to the ledgers at various places along the way. But if you envision the corporate as the issuer, it sends out, and the use of smart contracts here is important. The offering memorandum, the investor questionnaire, all of these are good examples of what could be smart contracts. The institutional investors see these contracts, they agree, they access the portal, look for the rates, and decide they're going to invest. They generate the trade, send the cash to the corporate at issuance. At maturity, the corporate sends cash to the account of the investor at depository trust company, which then credits the account of the investor. Smart contracts are used along the way, and all of the trades and cash movements are recorded on a distributed ledger that all the parties are involved here. But what are you not seeing here? You're not seeing a broker-dealer, and you're not seeing an issuing and paying agent. Two of the intermediaries have been eliminated, and that saves cost and complexity and accuracy. What you really have is a private blockchain that you create, and you would just be adding to for the ledger with DTC, new investors as they're added, and again, they would have access to all the documents regarding the program. You have also an automated regulatory compliance vehicle here that records and updates all trades and is confirmed by all the parties involved. So let's go to the next slide, and the benefits to the issuer here. There's more capacity in the program. We added 20 to 30 new investors. We diversified and expanded our investor base, which was nice. Finding investors that are the large broker-dealers don't have on their Rolodexes. You developed a direct relationship with the investor, and that was important to us. As we got close to maturity, we could contact the investor about rolling their investment and staying in our program, which added a lot of continuity. There was reduced cost. You're saving both the broker-dealer commission and the issuing and paying agent fees. A typical broker-dealer commission would be 5 basis points on the yield. And with any kind of a active program, the paying agent fees, which are flat fees, would probably add about a basis point to issuance. So, 6 basis points of savings for every $100 million of funding on an annual basis in the program, you're saving $60,000. So you can see how those cost savings can add up over time, and we took advantage of that. The smart contracts we talked about allowed for very efficient distribution of information to the issuers by to the investors by the issuer. So the next slide is the benefits to the purchaser. Again, smart contracts automate the repayment schedules, the ability of the platforms to link to your enterprise systems and your treasury management systems for straight-through processing. That is the holy grail for any treasury team, as the audience knows. Straight-through processing is efficient and error-free. And finally, for corporate treasurers, this was a nice way to give people access to higher yields on their money without having to go through money market funds. And with the regulations that have occurred now, people are having to deal with floating net asset values, and that can add a lot of complexity to money market investing. We still needed a portal to get this done, and Bloomberg certainly works well for this. Bloomberg could be added into the blockchain, and so that trade tickets, when they're created on the portal, would also be able to be communicated to all the parties involved. So you would, again, have another advantage of straight-through processing that way. But there are a lot of other portals one could envision using, including creating your own investor portal. So that's a quick case study on what I think is a good example for distributed ledger technology in the capital markets. Commercial paper has already gone to book entry, so it makes sense. It's a very logical choice for expanded book entry in the world of distributed ledger technology. So I'd like to turn it over now to Tom Dees, who will moderate the question and answer session.
Great, Brad. Thank you very much. That's a very useful discussion so far. We've had some questions come in. And the first one, I would refer to Richard to perhaps expand on this concept of there's a contract that's represented in the digital ledger, but there are also various other transactions that flow under the contract, such as interest rate resets, FX rates, many things like that. Can you just talk about how there's this overall framework, and then there are individual contracts, and who has permission to look at those, and how those interface back to the ledger systems of each entity involved in the overall transaction flow?
Thank you, Tom. That's an interesting question. One of the beauties of distributed ledger technology is you can control who views what data. And in this case, we can also talk about the feed. We've been talking about Thomson Reuters or Bloomberg, but you can control it through other and have access to bank systems and such. And it allows you to connect to all kinds of third-party data providers. And you can pull LIBOR or IBOR, whichever rates make the most sense for what your transaction is. And then we can put up what we call guardrails. We can put up constraints so that there's never a mistake made where your rate is off market, so that there's always a constraint of where your rate is. But all of that is customizable and buildable within our distributed ledger technology, so that only the appropriate people can see the data, and only the people that are allowed to make changes to that reference rate are allowed to access it. I hope that answers the question.
That does, and we had a related question that deals with, well, what if any of these accounts go negative, or how would that work? And I think what we're talking about here in this overall framework is that there are then new transactions that are generated, in that one of the entity that went negative records a loan payable. The entity, say the parent company operating the header account, would operate, would book the loan as an asset that it had given. And there would be, once a day when we close the system, there would be an interest rate drawn maybe from your Reuters database, and it would generate interest payable or accrued interest payable. Can you just elaborate on how all these things would happen to keep everybody balanced and square with each of the participants?
I think you were doing a great job there, Tom. I should just let you manage all the questions. That's exactly right. What we're talking about is when, if we have a company whose balance goes negative, so one of the subsidiaries has a negative balance, that's recorded. If it's an intercompany loan, you might borrow money from one subsidiary to the other. That subsidiary may have a negative, but the overall master account could still be net positive. If the actual master account, if that consolidated account goes negative, that will be dependent upon your credit relationship with your bank. That's still possible, but obviously now you're calling upon the credit with the bank that manages the pooled account. But as long as you have negative balances for a subsidiary, that's just recorded as a loan from one of your other subsidiaries.
Yeah, thank you. And maybe you could just elaborate. We've had another question come in that, when we look at the sequence of what's happened between banks and corporate treasuries, we've had certain banks that have popularized notional pooling, and in most cases there, the bank is kind of using its demand deposit accounting system to keep track of who's got cash, who owes what to whom, if the cash if the cash is lent by the cash-rich subsidiary to the center and then relent to a subsidiary that needs cash. And but I think correct me if I'm wrong, but the main characteristic of that system is it's using SWIFT and it's using the bank's demand deposit accounting system, and what I believe you all have done is to layer on an independent system that uses these transactions that you have to have permission to look at. Can you just elaborate on how this compares to the older way of doing things?
Exactly. And Tom, you hit the nail on the head. Traditional in-house banks do still move money by SWIFT and still have costs associated with it. So you are still actually moving money and making payments between you're cutting out third-party spreads. That's true. So there is reduced cost, but you still have transaction costs, and you still have a lot of potential for reconcilement issues and problems. You also have delays, but you also have the lack of metadata that transfers. There are newer systems, virtual account management systems that are out there, and those are great, but they also require you to be basically embedded with a single bank for the most part. And again, you lose a lot of the instant reconcilement, and you lose a lot of the transfer of metadata that makes reconcilement and settlement so much easier. So those are the big differences, but you're right, most in-house bank systems still rely on SWIFT and still rely on moving money from an account to another account, even though you're still within a single system and not relying on third-party counterparts.
Thank you. And then there's a question that's come up that kind of relates to the real-time settlement nature of this technology, and that as we all recall, what happened with when Lehman went down, it took 3 or more years to sort out which of the parties had a perfected security interest and were owed the amount that they had on deposit with a layman entity, they were owed that at 100 cents on the dollar versus those who were unsecured creditors and got a share of the liquidation pool in the bankruptcy. And so part of what's coming with, I think, this system is that each of the entities has a perfected security interest at all times in their share of the cash, and moreover, you can prove it in real time. The problem with Lehman Brothers, why it took 3 years, was they had to trace back through a welter of transactions and prove it to a judge. Can you just elaborate on that?
Yeah, Tom, I think it's one of the most powerful things about this concept in general, is that you have a real-time knowledge of who owns what. You can see with perfect visibility of who owns what at any given moment in time. And having worked on trading floors during financial crises, I can tell you there were moments. I worked at Citibank for many years, and I can tell you there were moments when Citibank hesitated about making payments because it was unclear whether the counterparties were going to be able to make their own payments and whether we should net payments or not. And there were moments when it was very unclear. And like you mentioned with Lehman, it took years to settle to figure out which subsidiary of Lehman owned which assets at what point in time. When was the bankruptcy declared? At what time? What we're talking about is perfect visibility of a secured account, and at any given point in time, the ownership of that security interest is clear. The permanent record, and the regulators love the concept that there will be this record as far as legal discovery and being able to go back and reconstruct the actual movements and flows of money. We'll be able to see that in real time. So I think you're exactly right. I think that kind of access to information in real time is going to change the concept of risk and default in the Treasury space.
Thanks. And Richard, if you could just talk about the practical aspects of this. You mentioned APIs. Is there interface technology like an API that interfaces the Smart Treasury to, say, SAP or one of the larger Treasury systems? And moreover, how many corporate clients are implementing this or have implemented it? And that will probably close us out. We're getting to near the end of our time.
Right. We already have a couple of large corporations. We can't disclose their names, but for Global 100 type of corporations that are already up and using this technology. We have a number more that are already in beta or in negotiations to start implementation. As far as building out the APIs and connecting into systems, we're already connected. We've already built the technology, the APIs necessary to connect our system, the FIS, the SAP, to a number of the major ERP systems, as well as many of the major banks. Not all of the banks yet, but many of the major banks. So as far as Citi or HSBC or Deutsche, we're fine there. So there will be banks, obviously, that we still have to connect and build out APIs to. But I think for most large corporations, we can get there pretty quickly.
Great. Richard, well, thank you very much. And thank you, everybody, for your questions. And Helmut, I'd like to just turn it over to you to close us out.
Yeah, thank you very much, Tom. It is now time to wrap up the webinar, I'm afraid. Thank you very much to our speakers, Richard, Brad, and Tom today. I would also like to thank everyone who joined today's session. I'm sorry if we didn't reach your questions in time, but as I mentioned at the start, we will be uploading a recording of this webinar on the ACT website along with the presentation in the next days, and we'll be sending you the link. Thank you, all of you, for listening. If you can spare a moment to provide feedback on the webinar, we would be very grateful. please select the feedback widget in green at the bottom of the screen. The facility to do this will remain open for a short while after the webinar ends. From all of us here to you, thank you and goodbye.